joining us on Legacy Markets. This show is centered on finance and the economy, so we want to talk briefly about some of the key issues we will discuss in future shows. So Abigail, many of our audience members and viewers are new to this entire area of capital markets and the Belize Market Return. Can you help them, as well as myself, understand the capital market and exactly what it is?
So the capital market is just a place where you have individuals with a need for long-term finance, and then you have individuals with patient capital. So patient capital is just where you have people with monies set aside, just needing to put it somewhere where it can grow. And so when individuals with a need for long-term financing and individuals with a need for patient capital come together to do business through two types of financial assets, those being debt instruments and equity instruments, that's where the capital market takes place. And just for clarity, the debt instruments that I'm talking about are bonds. Meanwhile, for equity instruments, those are referring to stocks or shares.
Thanks, Abigail. So before we get into how Legacy measures this investment, can you tell us what the Belize Market Return is?
Yes, so the Belize Market Return, or what we often just call the BMR for short, is a numerical tool that we use to measure or take a look at all public investments in Belize. And so this would include those short-term financial assets or investments like savings accounts. But we also take a look at long-term financial assets or investments like stocks or other public investments that are available in our market.
You mentioned public availability. Can you go into some more depth in regards to that?
Yeah, so when I say publicly available investments or securities, those are just referring to those investments that anyone can participate in, anyone has an opportunity to own. And so these publicly available securities are issued by public companies. So a good example of this would be the Belize Telemedia Limited, or what we tend to know as BTL. And so BTL issues their own share and stock, and anyone has an opportunity to own a share or stock from BTL. But just for comparison, on the other hand, we have Smart, or they trade as Smart, but they're known as SpeedNet as well. And Smart is a private company. It does issue its own share or stock, but not anyone can own it. It's private. Another good thing, or good to know about a public company versus private, is that a public company can release financial statements and any one of its shareholders can view it publicly. But with a private company like Smart, not anyone can look at their financial statements.
Okay, so just to reiterate, once a company is public, the BMR can look at that information as public information.
Yeah, because it's available for anyone to see and take a look at.
Okay, so considering the BMR for this quarter is 3.7%, how can the audience take that information and use it for their own benefit to, let's say, invest or to make a decision?
Yes, so the Belize Market Return, or the BMR rate of 3.7%, should be used as a benchmark. So when you're considering to take on an investment, you want to consider how much return am I getting currently and comparing it with your BMR rate. So if you notice that the return or the money that you're getting at this moment is below that 3.7% rate, then you might want to think about diversifying your investments and getting something that would give you a return higher than you're currently getting, right? But then if you notice that your current investment is earning you higher than that 3.7%, then now at this point you want to consider, am I taking on enough risk? Am I comfortable with the current risk that I'm taking on with my investment?
Okay, so exactly how far back should one look at or do research on? Let's say BTL, for example. Am I looking at their last year? Am I looking at their past 5 years? Exactly how far back should our viewers go back to make that decision?
So at Legacy, we take a look at 13 years of historical performance. That's for looking at the long term. But we also take a look at the medium term. And so that's about 5 years of historical performance.
So just a note of interest too, a person making an investment should not only look at the returns to the investment, but they should also take into consideration risk.
Return is one side of the coin, but you also need to consider the risk that you're taking. And risk is, the way we measure the overall risk is by looking at a variability. So we looked at the difference between the return you're getting in a given period and the average return over the review period.
So essentially there's two different variables, the risk and the return. So with that information, how does an investor make a decision?
Yes, so return is a good measure, but you need to consider the risk too. And so when you look at the risk, actually we developed a metric called the return to risk ratio. And so the return to risk ratio just allows you to know for every unit of risk that I'm taking on, this is the return that I'm getting back, or this is the money that I'm getting back.
You know what, Abby, this conversation is getting interesting, but we do need to take a quick break for a word from our sponsors. But when we come back, we will talk more about the BMR's record for this quarter. We'll be right back.